Hi, welcome back to another edition of Lipper's Fund Flows Insight. My name is Tom Roseen. Thanks for joining us this week. I'm going to be reporting flows for the week ended Wednesday, January 30th, 2013. You know, we really had quite a strong performance. The last several weeks, we've had really good performance. In fact, we saw last Friday that the S&P 500 actually reached a new milestone, went up to the 1500 mark, and we hadn't seen that since 2007. And investors followed with investment habits to suit. We saw them put in about $10.2 billion of net new money into the conventional fund business. That's excluding ETFs. We'll talk more about ETFs as we move on. But really, it wasn't just that. We also saw and we heard some good news that the PMI, that's the Purchasing Managers Index for both Europe, United States, and even China, were better than expected. So we had some good news. Later on in the week, we decided to kind of mellow out on the market returns and that kind of stuff. But overall, again, a good week to be talking about. Well, let's see how these events actually turned into good flows for the industry. If we take a look at our macro groups, equity funds saw $5.8 billion in net new money enter their coffer. That's a really nice chunk of change. We also saw taxable bond funds continue on their merry old way, $2.9 billion. And we'll talk a little bit more about that later. But people were certainly saying, oh, people must be pulling out of taxable bonds and going into equities. Au contraire. Actually, they're just continuing on their merry old way and then padding the coffers of equity funds as well. Municipal bond funds saw pretty good flows in, a little bit less than $600 million. And money market funds saw just a little bit under $1 billion in net new money enter their coffers. So, when we're taking a look at this, we kind of scratch our head because really, performance has been very good. We saw for the 4-week period ended again. Now this would be the 30th, so I'm not really doing a year or month-to-date period, but basically a 30-day period that we're taking a look at. 4.82% for the average equity fund as far as returns go. So very strong January returns, and we saw that in the flows as well into equity funds. Let's take a deeper dive into the equity fund group. We saw that at a 0.59% return for the week period that we're talking about. It's the 4th consecutive week that they've actually seen inflows, and that's kind of an amazing statistic at its own. As we recall, equity funds were the pariah unless you were in select equity fund groups. Internationals were seeing some good money, emerging market funds. So we'll talk more about that. But really, 4 consecutive week that we've seen it, $5.8 billion, and it's the 4th consecutive week we've seen plus side returns as well. So this is something again that we are certainly writing about and talking about. Now I want to give you a number so you can kind of get a perspective of what happened for the 4-week sum. We saw about $20.7 billion in net new money enter their coffers. That's the first time that we've seen a consecutive 4-week period take in money of that size since April 12th, 2000. Now, domestic equity funds took in $2.9 billion. It's the 4th consecutive week we've seen inflows into that group, and this is where we're actually saying there's really a change in investment pattern. Non-domestic equity funds saw about $2.8 billion, and if we take a look in a little bit greater detail, we see again the pariah that I've been talking about. Large cap funds taking in $1.5 billion of net new money, and investors were willing to keep on that risk train, so to speak. Emerging market funds took in about $1.2 billion. This is the 4th consecutive week in a row that they've taken in over $1 billion in net new money. So investors certainly were encouraged to do that. Now overall, as we take a look now, we want to take a look at equity funds on the ETF side. And that certainly didn't change at all either. We saw about $6.9 billion in net new money coming to their group, but here's where it was a little bit different. Prior 2 weeks, we saw net outflows. This is the first week in 3, we saw net inflows. SPY was the main benefactor of getting that money. $4.6 billion in net new money, followed in distance by Select Energy Spider, taking in about $400 million. And then we saw the iShares MSCI US Minimal Volatility Index taking in about $300 million in net new money. At the bottom of the group, though, this is what's interesting. Yes, we see a little SPY. Ignore that. That's probably just somebody jumping in or jumping out of the funds. But we saw gold or precious metal funds actually taking on the chin. So people are kind of backing away from that. Let's play it safe. Let's be in the precious metals. Let's have those backup plans. We're seeing this the result of the Fed pushing us into riskier assets actually happening and actually forcing people to buy into the riskier assets, and we've had a very good rally in the market for that as well. Well, let's go ahead and take a look now at fixed income funds. Now again, I told you fixed income funds did not see an exodus. A lot of people said, oh, you got good money flowing in equities. Definitely, fixed income funds were still taking in good money. This is the 13th consecutive week that they've actually taken in. They are putting a little bit more risk on. $2.9 billion in total, basically, on that. It's the first week in 5 that we've actually seen a negative return for this group. It was only down 0.15%. But where we saw basic money going into was the corporate investment grade debt funds. They saw about $1.4 billion in net new money. It's the 33rd consecutive week we've seen money coming into this group. And again, on the riskier side, flexible portfolios funds saw about $0.8 billion in net new money come into their group. And that's one of the things that we wanted to talk about a little bit. Is that was a 6th consecutive week. So this is a risk-on approach. They're putting risk on the fixed income. They're putting risk on the equity funds. And again, this has been pretty much a party of people putting money back to work. We think a lot of money was sitting up, pent-up demand. At the end of the year, people wanted to wait till the tax loss selling was done, and wait to see what the markets were going to do. The uncertainties were over, and now we're seeing that change. People are actually putting money back to work in both asset classes. Now, ironically, if we take a look at the ETF side of fixed income, we see that they didn't actually pull in that much more money. About $0.8 billion net new money came into there. We saw a dichotomy. At the top two group, we see a 20-year ultra short obligation group, so 20-year treasuries, basically taking in about 210 million. And then we see the opposite side of it, not an ultra short, but basically a long position, 20-year treasury fund, taking about $200 million as well. And then we take a look at the bottom, the spider 1 to 3 month treasury bill, basically losing about $270 million. Not that big of a deal. But at the bottom again was, just I'm going to call it short treasuries. Safety issues kind of were at that as well. So, well, let's go ahead now and take a look at the muni bond fund side. The muni bond fund side is pretty interesting as well. They've had their fifth consecutive week of positive flows. And it's the first week in 6. Again, we saw a downside performance, 0.41% decline as well. But again, it's the 5th consecutive week. Again, the uncertainty's over. People know about the tax rates. They know what's hitting them between the eyes. And they are preferring that tax equivalent yield from municipal debt funds over their taxable brethren in some cases, because they're finding out some good deals are still to be had. Basically what we saw is we saw about $600 million in net new money coming to that coffer, and what it made up the lion's share was national munis, bringing in about $439 million in net new money into that group. So again, this thing that people thought that the munis were going to be on the wayside certainly was a rumor that was not true. We're seeing some good response, good money flowing into this group. The last group didn't take in very good money, but that's as to be expected. Money market funds, so about $900 million in net new money entered their group. It's the first week in 3 they had positive flows, but here's how it broke out. Taxable money market funds, so about $4.7 billion in net new money. Tax-exempt money market funds, so about $3.8 billion in outflows. But when we break this out and take a look at who was doing the investment on the taxable side, institutional investors put in about $11.2 billion, while the retail investors took out 6.5. Here's that money being put back to work in equity funds and also to some extent into fixed income funds. Well, it was really a good week to be taking a look at flows. And here's the things that we're going to be looking at going over the next week. First of all, we've had some fairly good reports. Thomson Reuters has been reporting about 68% of all those S&P 500 constituents that have been reporting earnings have beat their expectations. We're going to look at that to continue on. If that happens and continues on, we could see some continued flows into the equity universe. On the other hand, people were saying, hey, listen, this might be overextended a little bit rich. We need to have a little bit of pullback. And we might have seen that in the unemployment report that we saw today. Basically, we had some good numbers. We saw about 157,000 net new jobs being created. But the problem is, it was expected to have 170,000. And we saw that there was an uptick in the unemployment to 7.9. Now, this economy, this workhorse economy is just continuing to run on. But again, people are getting a little bit concerned that we might be getting a little bit over ahead of ourselves in our valuations. And certainly we're seeing this in the exuberation we're seeing from retail investors. Well, I'm not sure what's going to happen next week. I'm sure you aren't either. So you can join us next week. You can come to this site and take a look at our video. Our analysts will give you a little bit of rundown, or you can go to lipperusfundflows.com. There you can go to do a deeper dive yourself, find out what's been going on in the groups that you want to take a look at. And again, if not, join us next week. Until next time, my name is Tom Roseen, wishing you the best in your wealth planning and creation.